In the second part of this training, we will discuss the basic terminology of Forex. This can be useful when you have an experienced client who's using some terms, and in that case you will be prepared. You will know everything about what he's talking. Also, it will help you to better understand trading platform and Forex market, Forex trading in general, as well as to present the market and trading as such to the client even better. It is important to understand that you don't have to speak in terms only with your client. If your client has never traded before, he doesn't have much knowledge or experience in Forex, that would make no sense at all, because client simply will not understand most of what you're saying to him. And your job is actually to make him understand things. So the more simple you explain things, the better. But for you to be better prepared to sell the product to the client, of course, you need to know a little bit more about the product than the client knows. So that's why this section also will help you to better understand the product. As you will see, this part will include some formulas. They are really simple, some simple calculations. And again, that doesn't mean that part of your job will be to do some calculations on a daily basis. All the calculations are done automatically by the trading platform. So this is not going to be your job unless your client maybe asks you to calculate something for him. And at the same time, you need to know these calculations again for better understanding of the platform, and also to pass the test which you will have in the end of this training. So let's begin with a pip. Pip is an abbreviation for point in percentage. So sometimes you can hear people calling it pip, sometimes people calling it point. The both words are correct. A pip might be a little bit more popular term. So basically it's a very small measure of change in a currency pair in the Forex market. A pip is a standardized unit and is the smallest amount by which a currency quote can change. So usually it is the fourth digit after comma. Or in other words, 1 pip equals to 0.0001 or 1/10,000. Probably when you went to the bank or currency exchange point, you noticed that usually they present you a shorter version of the price of the currency. Because when you're exchanging a smaller amounts, it doesn't matter for you what is the third or fourth digit after the comma. But when trading in Forex, traders are dealing with much bigger volumes. That's why even a little change by 1 pip, by 0.0001, when the price changing by this little measure, that can bring a profit or a loss to the client, because the large volumes are bought and sold in the Forex market. For example, the price changed from 1.1225 to 1.1228. So as you can see, the price has changed, the price has increased by 3 pips. Also on the picture in your slide you can see example of the structure. So the fourth digit is continued pips. So if you have 5 as your fourth digit after comma, that means 5 pips. Then 40, 300 and so on. This is just as an example. Terminology usually is used to simplify the language. So instead of saying the price of Euro USD has increased yesterday from 1.1225 to 1.1228. It's pretty long sentence to say. You can simply say that the Euro USD became more expensive by 3 pips. As you can see, it's much more easier. The next term we're going to discuss is called lot. So just like we're using different measurement systems like kilograms, kilometers, there is also a measurement like system in the Forex market. So for example, we're using kilograms to measure the weight. And we all know that 1 kilogram equals to 1000 grams. So in this case, you need to learn that Forex is traded in specific amounts called lots, or basically the number of currency units you buy or sell. And you need to remember that one lot, when you're trading currencies in Forex, always equals to 100,000 units. So once again, if you're buying, let's say, 100,000 euro on the platform, yeah, you can simply say I'm buying one lot. So that makes communication easier. Also, if you're buying one lot or selling one lot, then the price of 1 pip is 10 units. In other words, if you're buying, for example, $100,000, one lot, every time that the currency exchange rate of dollar will be changing by 1 pip, by 0,0001, that means you will be having a profit or loss of $10 in this case, since you're trading in dollars. Also, there is a specific formula which you can see highlighted in bold letters. So price of 1 pip can be very easily found. You need to take the amount of lots and multiply it by 10. So here you can see a little table with some examples. So for one lot, the volume that is bought or sold is 100,000, and the price of 1 pip will be 10, as you already know. You can see the word units, so it would be useful to know that when you're trading a certain currency pair, instead of the word unit, basically you can use the name of the base currency. As you already know, the base currency means the first currency in the currency pair. So for example, if you buying one lot of Euro USD, you're buying 100,000 euro, because euro is the base currency, the first one. So if you're buying, let's say, 2 lots, as you can see, the volume becomes twice bigger. Yeah, so altogether it's 200,000, and the price of 1 pip also becomes twice bigger. If you use the formula provided to you in the previous slide, yeah, you can see that you will get the answer 20. So the amount of lots is 2. We multiply it by 10 and we get 20. And one more example, if you're buying, let's say, half of the lot. Yeah, so in Forex you can also buy half of the lot, 0.65. Yeah, this is called fractional lot. So in this case, if you're buying half of the lot, you're buying 50,000, and the price of 1 pip in this case will be 5 units. Now let's talk about leverage. This term was already used in the first part of the training, and I explained you that with the help of leverage, clients actually can invest in Forex without huge investments, because brokers provide them leverage. So, leverage is the ratio of the trader's funds to the size of the broker's credit. In other words, leverage is a borrowed capital to increase the potential returns. The leverage size usually exceeds the invested capital for several times. The size of leverage is not fixed at all companies, and it depends on trading conditions provided by a certain Forex broker. So, it means that the ratio will not be the same at every company. Some company can offer you bigger leverage, some company can offer you smaller leverage, so it's up to you which one to choose. Basically, Forex leverage is a way for a trader to trade much bigger volumes than he would using only his own limited amount of trading capital. So let me give you an example. If you are a trader, and let's say you invest a few $100 on your deposit, you have 500, for example. Yeah. The thing is that in the Forex market, you cannot buy or sell less than 10,000 units of a particular currency. Forex is the market where banks are trading, so they're not interested in very small trades. Yeah, so the minimum one is 0.1 lot or 10,000 units. So then there is a question: how can I buy 10,000, let's say, dollars or any other currency if I have just $500 on my account or even less? And the answer to this question will be exactly leverage. So every time you will be buying or selling some asset, some currency, the broker will be charging you only a little amount, and will be adding to this little amount his leverage. Yeah, like the credit. So that's why to buy 10,000, for example, you need only to invest like $50 and so on. I will show you an example later, so it will make a little bit more sense. In this slide you can see examples of standard leverage. So for example, for currencies and commodities, that could be 1 to 200. For cryptocurrencies and indices, if you're trading on them, it's 1 to 50, and for stocks the ratio is 1 to 20. So these are the leverages which are used on the trading platform. But for other platforms, of course, they could be different. So for example, if you want to buy some particular amount of currency, you don't need to invest the whole amount, but only like 200th part of it. Yeah, the rest is added automatically as a leverage by the broker. The good news for the trader is that he does not need to share his profit. So he's getting extra money, like a credit, a leverage from the broker, but when he makes profit, he does not need to share it with the broker. At the same time, he's not sharing losses as well. So all the profits and losses coming from the client's free balance. All of these terms, I believe, will make even more sense when you are introduced to the trading platform and you see how it happens in practice. So as I told you, when trader buying or selling a particular currency, he's investing only a small part, the rest is leverage. So this small part is called margin. So when trading Forex, you are only required to put up a small amount of capital to open and maintain a new position. This capital is known as the margin. For example, if you want to buy 100,000 worth of USD JPY, so basically $100,000 or one lot of dollars, you don't need to put up the full amount. You only need to put up a portion, like 500. How did we find this 500? Basically, in the end, you can see the formula of the margin. So we need to take the volume and divide by the leverage. So in this case, the volume is $100,000. The leverage is, as we already know, 1 to 200 for currency pairs. So we basically need to divide 100,000 by 200. And the answer will be $500. As I said before, these calculations, they are done automatically by the trading platform. But of course, the level of margin also depends on the leverage which is provided by the broker. Margin can be thought of as a security deposit that's needed to open a deal and keep it open. Yeah, so probably you know what is security deposit. For example, you're renting a car and you need to pay a specific amount of money as a security deposit. So when you return this car, if let's say you broke something and there is a scratch on the car, the renting company will charge you this money. They will not give you back this money, they will use it for repairing of the car. But if everything is alright and the car looks just the way it looked when you rented it, they will give you back your security deposit. So that's pretty good comparison with the margin. Every time you buy or sell something on the platform, the certain amount of margin is reserved on your balance, so you cannot use this money to open new deals. The same way the money sometimes is reserved on your bank account. Yeah, so let's say you made a purchase, but the money was not charged yet. Yeah, so this amount is reserved. You cannot use it to make new purchases. The same thing is about margin. But the good news is, after you close your deal, doesn't matter you closed it with a profit or with a loss, you are getting your margin back. So all the losses and all the profits, they are going directly into and from your free balance. Yeah, so margin remains the same. It's security deposit. You give it to buy a certain amount of currency and you're gonna get it back when you close your deal. This is just like a guarantee for the broker that you have enough money to open new deals, to continue trading. So let's take a look at the example of how to calculate the margin. For example, we're buying one lot of Euro USD. So formula is, we take volume, which is 100,000, and we divide it by 200. So the answer is 500. The base currency, the first one, is euro in this case, so we're writing euro. 500 euro is needed as a security deposit to buy 100,000 Euro USD. So let's say after a while you made some profit, for example $30. So you close the deal, the $30 remain your profit, and you're also getting back your margin, your 500 euro in this case, going back into your account. Even if you would lose something, like lose $30, yeah, and you close the deal, still the margin totally going back into your account. The next term we're going to discuss is called spread. So every broker charges some kind of commission for his services. And if you speak about Forex brokers, they're doing the same. So the most important commission is called spread. It's a commission that is charged by the broker at the moment of opening the transaction. So you're paying this money for opening the transaction. At the same time, you are provided leverage automatically. Yeah, so basically that's what you're paying for, to get access to the market, to be able to use leverage, to be able to open a certain deal. So every time you open a deal, you will see like a little minus on your balance. Yeah, because any transaction opened by the client opens in negative profit or losses of several points or pips. So if you open the deal and you see minus $2, there is no need to worry. This is simply commission which was charged by the broker for opening this deal. Also, you can explain spread as difference between buy and sell prices. So if you ever exchanged some currency in the bank or maybe a currency exchange point, you noticed that for every currency they have two prices. Those are called buy and sell prices. Sometimes they're called bid and ask. Yeah, so they always are different, because when you're buying currency from the bank, they're charging you more. When you actually selling currency to the bank, then bank using a better currency exchange rate for itself. Yeah, so basically like this, banks are making extra commission, which is also called spread. Here you can also see the formula of the spread. You find the difference between buy and sell price. On the platform you also will be always seeing both prices next to each currency pair. And difference between them multiplied by the price of 1 pip, which you already know how to find, will be the formula of spread. Let's take a look at the example. So for instance, we're buying one lot of Euro USD. Yeah, so basically 100,000 euros. And let's say that the buy and sell prices are 118.83 and 118.85. So according to the formula, we find the difference between these two prices. So we deduct the smaller one from the bigger one. And we got a result of 2 pips. Then we're also using the formula how to find the price of 1 pip. We take the amount of lots, which is 1 in this case, and we multiply it by 10. So in the end we get the answer of 20 USD. Please pay attention, because when you calculating the spread, the answer will be in the quote currency, in the second one. Spread is charged in the quote currency, so that's why in this case it's USD. But when you're looking for margin or the value of 1 pip, then it will be base currency, the first one. There are two types of spread. One is called fixed spread. It remains the same even though the prices are changing, so it does not depend on market volatility. And there is also floating spread. It fluctuates because of market conditions and it depends on market volatility. So on different platforms, on different trading platforms, different types of spread could be used. Some platforms have fixed spread, some have floating spread. It also could be different for different groups of instruments. Yeah, for example, the spread used on our trading web platform is mostly fixed, yeah, with exception for floating spread for the cryptocurrency. So the main difference, as you can see, is that fixed spread does not depend on market volatility and floating spread depends on market volatility. So here that would be useful to talk about volatility itself. What is it? So volatility is the change of the asset price from minimum to maximum for a certain time frame. Or to put it more simple, volatility is fluctuation of the market, how actively it fluctuates. You can imagine the pulse, the heart rate of the person who's doing sports actively, some high intensive training. Yeah, so you will see that it jumps up and down pretty often. So that could be an example of high volatility in market. And if you imagine the person who is sleeping deeply, yeah, in the middle of the night, then his heartbeats will be changing much slower. It will be like much calmer. So that could be an example how the chart would look for the low volatility. So in high volatility the price is changing more and faster, more often. For low volatility the price is changing much slower. So as you could guess, it is easier to make and faster to make profit if you have a high volatility. Yeah, if something happens in market, some kind of news, and then the chart going up and down, so you can make profit much faster. At the same time, if we're speaking about risks, then of course risks will be higher always in high volatility because it's a little bit less predictable. There is another commission which is present on the platform. It is called rolling commission. So this commission broker company charges for transferring the leverage to the next trading day. This commission is charged every day until the deal remains open, and the commission is charged at midnight by GMT time. So GMT time means Greenwich time zone, UK. So imagine that you are renting a car for 2 days, or for example for 1 day. If you return it after 1 day, of course nothing extra will be charged, only the money you paid in the beginning. But let's say you returned it later, not after 1 day but after 2 days. Yeah, so according to the contract you will need to cover also the second day, you will need to pay extra. So imagine now that you are trading in the platform, right? And when you're opening a deal, you are given leverage by the broker. So if you're trading, let's say, within the same day, yeah, then it means you close your deal faster, you return leverage faster, so it can be given to some other client. But if you keep your deal open for 1 day, for 2 days, for 3 days, and of course this leverage you're using much longer, and that's why you will be paying extra rolling commission for every 24 hours that you are using the leverage. Yeah, so for example, if you opened a deal at 1 p.m. and closed it after 1 hour at 2 p.m., then of course rolling commission will not be charged, only the spread which you pay in the beginning when you open the deal. But if you opened it, let's say, at 1 p.m. Tuesday and closed at 1 p.m. Wednesday, 24 hours later, then the commission will be charged at the midnight. Even if you open your deal 5 minutes before the midnight by GMT time and close it 1 minute after midnight, right? Still, this commission will be charged. The deal can be closed basically anytime by the client. It's up to him. But sometimes clients don't want to close their deal too fast. They want to make it long-term deal because they're making good profit. Yeah, so that's why they're waiting longer, and for every trading day there will be a rolling commission charged. Now let's talk about trends. So as you know, when we speak about some trends, let's say in fashion or in some other sphere, we mean that something is popular. So the same term is used in Forex trading. And there are 3 different types of trends we're going to discuss. The first one is called upward trend or bullish trend. This is the one basically which you can see right now on the picture on your slides. Yeah, so when the price is going up. Of course, it doesn't mean that it goes up all the time. Yeah, sometimes it might go a little bit down. But all in all, we see that the price moving up in that direction. Also, this kind of trend is called bullish. The second type is called downward or bearish trend, so when the price is going down. The third type is called flat or horizontal trend. It basically means that the price not going only up or only down, basically the direction is changing. It looks like a wave on your chart. And in general, it's impossible to say whether the price goes only up or only down. Yeah, you can see that it goes up and down all the time. Yeah, so it goes like to the side direction. In the next part of the training, when we will be discussing the trading platform, you will be able to see examples of these 3 types of trend. Now let me explain you why upward trend is called bullish and downward trend is called bearish. They are called accordingly to the animals, bull and bear. So if bull decides to attack his victim, he will be using his horns, right, to throw the victim in the air, basically upwards. That's why the trend is called upward as well. So you can imagine the bull using his horns and throwing the price upward. Now, when we're talking about the bear usually try to put his weight on his victim, to put victim to the ground. Yeah, so in the same way you can imagine like bear tries to put the price in the downward direction. That's why the downward trend is called bearish. You will be surprised probably by these words, like bullish and bears, they're actually even more popular among the traders than upward and downward trends. So by the same logic, we are talking about 2 groups of traders, of investors. Ones are called bears and the others are called bulls. So bears are basically traders or investors who trade for the downgrade. Traders opening deals for the sale of the currency in connection with the expectation of lower prices for it. So basically, if you predict that the price will go down in the future, so that's why you're selling it right now, selling the currency, then you in this case are a bear. Bulls are investors trading on the increase, traders opening deals on purchase of the currency in connection with expectation of increase of prices on it. So if you expect that, let's say, American dollar will go up in the next few days and you are buying right now dollar because you will sell it after 4 days, yeah, so you expect the growth. Then in this case you are acting as a bull. You would be called a bull. So all the time when we talk about trading, there are both. There are those who sell, there are those who buy. There are always bears and bulls present. But usually, I mean, always one of these categories will be stronger. There will be more bears at some point and more bulls at the other point, or maybe bears will be more active. Yeah, so they're like fighting all the time between each other. So when you see that the price is going up, growing in the chart, that means that the bulls are more active now. There are more bulls. Yeah, so there are more purchases of the currency, more deals to buy. And when you see that the price in the chart going down, yeah, for example, you see the red color candlestick, that means that bears are more active. Yeah, they're investing more money, they're opening more deals on the sale of this currency. That's why the price is going down. As you can see in this example on your screens, whichever of three trends you have, there is never gonna be only movement upwards or downward. Yeah, as you can see, there is always fluctuation. Yeah, time after time the price changing its direction. So that's why we're gonna talk right now about the correction and the rollback. So changing the direction of the market price back to its original movement is called correction. At an upward trend, bullish trend, this change is called the rollback. In case of downtrend, bearish trend, this change is called correction. So to put it simple, that means that, for example, if you have a bullish trend, the price in general going up, time after time you will see that actually the price is going slightly down, and then again up, and then again a bit down. So these moments when the price is going slowly a little bit down, they are called rollbacks. So it's like price rolls back time after time. So in this case, bears are becoming a little bit more active. And if you have a downward trend, the price is going down, time after time you will see the fluctuation that the price actually moves a little bit upward. So this would be called correction. So in general, bears are winning, let's say, yeah, but bulls time after time is becoming a little bit more active. Yeah, so to put it really simple, basically correction or rollback could be called a temporary change of the trend in the opposite direction. Most, at least the big amount of people who are traders, who are trading in Forex market, this is not the only thing they're doing, right? So in most of the cases they're having the jobs, the families, the hobbies, and so on. So obviously no one is sitting in front of their screen, in front of their charts 24 hours, 5 days a week. And of course, price is changing in the market all the time. So it's not only important to open the price at a good time, to open the deal, but also it's very important to close it when you have a profit you're satisfied with, right? Because you might open the deal in the morning, you see that everything is good, price is growing, you're getting profits, and let's say you don't close this deal, and you go out, you come back to home after 2 hours, and you see that you lost all your profit and actually already lost even more money. So for this not to happen, there are certain instruments on the trading platform which could be very, very helpful. The first one is called take profit. So basically take profit automatically closes the trade once that predefined amount has been reached. So when you're opening a deal, you can set the desired profit on this deal, and as soon as this profit is reached on the deal will be closed automatically by the platform. For example, you open a deal, you set desired profit of $10, and as soon as this profit is reached, the deal is closed automatically. Of course, there is also another possibility that when you open a deal, the price can go in the wrong direction, not the one you predicted, because something happened in the world, yeah, which influenced the currency price. So you might lose money. So, of course, no one wants to lose all the money on the balance. So to avoid this, another instrument can be used. It's called stop loss. So stop loss automatically closes your position when your losses on that trade reach your predetermined stop loss price. So once again, when you are buying some currency, for example, you can set up not only the take profit, but also the amount of loss which you are ready to take as your maximum, right? For example, you are not ready to lose more than $20 on the deal. So you can set a stop loss of $20, and if at some point you will lose on this deal $20, the deal will close automatically. So you can be sure in this case that you're not gonna lose more than $20. So even if you lose, you're not losing more than a particular amount which you set up yourself. These instruments also will be shown on the trading platform, how to set them up, and so on. Both of these instruments could be set up together at the same time, but basically it's up to the client. If he wants, he can set up only take profit or only stop loss, or none of them or both of them. These kind of instruments, they do not require any extra commission. They are basically free. Also, you can set that up anytime. So if you can do that when you're opening the deal, or you can do it later. Also, before any of these levels is reached, you can change them. Yeah, you can move a little bit, take profit higher or stop loss a bit lower. It's like up to you. So of course, when you're buying, then your take profit will be above and stop loss below. When you're selling, it will be opposite. Take profit will be below and stop loss will be above the chart. There are two ways to open a deal. First way is to open instantly on the platform. So you go to the platform, you choose how much and which currency you want to buy or sell, and you simply press the button. Either buy or sell, according to your prognosis. If you believe that the price will go up, you buy. If you believe that the price goes down, you sell. So that's one of the ways, and the other one is called a limit order. There is a specific button on the platform for that. So it means to purchase or sell an asset automatically at the specified price. So imagine you have the prognosis that as soon as the Euro USD will cost 1.12, let's say, yeah, then the price will start growing. So you have a great prediction, but the problem is that right now the price is much higher, 1.12.30, let's say. So you need to sit and wait until Euro USD will drop to the needed price, and then you would like to start buying. So not to sit and wait for the whole day, because you don't know how fast the price will change, right? It can take few days. You can set up a limit order. So you set up a specific price at which you want to start buying or selling this currency. And as soon as this price will be reached in the market, the deal will be opened automatically for you, and the spread, the commission will be charged. So when you set a limit order up, you're not paying any commissions. So only when the deal is actually opened in the market. I guess you can compare it to the alarm clock. You don't want to oversleep to work, let's say, so you set up alarm clock for 8 a.m. in the morning, then it wakes you up. It's a good time to wake up. The same kind of thing is for limit order, so you don't want to miss a good price to start buying currency. So you set it up as your alarm clock, and as soon as this price actually is reached in the market, then your deal is opened automatically. Let me give you another example. Imagine that your friend selling cars in the salon, in the car shop, and you know that once in a while they have a really good discounts. So you like one of the cars really very much, and it costs $10,000, which is not the amount of money you're ready to pay. So you call your friend and ask him, look, if you have this good discounts, if you have 50% discount on this particular car model, then I will send you right now money. Please buy it for me, or at least reserve it for me, okay? Buy this car. If there will be discount, but not 50%, let's say 30% or 20%, then don't buy it. Just let me know if there are no such discounts and give me my money back. So that's the agreement you have. So this is kind of a limit order. If they will have 50% discount on this car and it will cost $5,000, your friend will buy it for you. So you will not lose a great opportunity. But if the price is not so good, it will be, let's say, only 10% discount or 20%, then your friend will not be buying a car, he will simply give you the money back. So that's kind of a limit order if we compare it. So the next term is called lock. So Lock happens when a trader doesn't close a losing position, but opens the position of the same size in opposite direction. So, for example, the client opened deal to buy one lot of Euro USD, and he's losing some money on this deal. Okay, so instead of closing this deal, he opens one more deal, also on Euro USD, the same instrument, also for one lot, the same volume, but this time not to buy, but to sell in the opposite direction. So he have two exactly the same kind of deals, yeah, but one to buy and one to sell. We're not gonna go too deep into this, in which cases this is used, but there are some situations when lock could be actually very useful for the client. I would say that retention agents deal with this much more since they're dealing with clients trading. Yeah, but for you as a future conversion agents, at least potential ones, yeah, you don't need to go too deep into this topic. Simply remember that lock means to open the same deal, the same size, the same instrument, but in the opposite direction. If you were buying, then you start selling. If you were selling, then you start buying. One more term, it's called gap. You can see the example on the picture. So a price gap describes the situation where a stock opens at a price either higher or lower than the closing price the day before. Yeah, so like in this case, you see the price was at one level, but then the next candlestick is much lower. So usually this situation for currencies happen after the weekend, yeah, because during the weekend trading is not happening. So very often we can see that on Friday, let's say the price of dollar closes at one rate, but on Monday it's totally different. Probably you noticed in the banks, yeah, when you take a look at the currency exchange rates, very often on Friday it's one rate and on Monday it's totally different. Yeah, so something happened over the weekend, prices changed and the market opens with totally different rate. If we talk about the shares, the stocks, then it happens more usually, yeah, this kind of situations, this kind of gaps, because as we already discussed, stock shares available only during a particular trading sessions. If you want to trade on American shares, then you can do that only during American session time. If you want to trade on Asian stocks, then only during the Asian time. Yeah, so that's why there are more these breaks for the night. Yeah, and after these breaks, of course, the price could be totally different. Yeah, so for Forex, for currencies, just remember that usually it happens after the weekend or after some big news, yeah, some big events, which change completely the situation in the market. So is it a good or a bad thing, a gap? It's actually could be good, but it also could be bad. Yeah, that depends on the particular situation. So let's take a look again on this picture on your slide. So before the price dropped, yeah, before the gap, if you were, let's say, buying, of course, this kind of gap will not be good for you, because on Monday the market opens with a totally different price, and that means losses for you of pretty big amount of pips, so you're losing money. On Friday everything was fine, on Monday you open your deal and you have a pretty big minus there. Again, for this not to happen, you can use stop loss, not to lose too much money. On the other hand, right, if you before the gap were selling the currency, yeah, so that's good news for you, because on Monday, as we can see, the price opened much lower, and that means pretty good profit for you. So that actually depends. Yeah, sometimes it's possible to predict when the gap will happen, and that's a very good situation. Yeah, because if you know that on Monday, let's say the price will be much higher than right now on Friday, then of course you can buy it right now, this currency on Friday, and on Monday you will have a good profit. So there are a couple of more terms which might be useful. The first one I would like to explain you about is called risk management. So this is like traffic rules when you're driving a car. If you're driving car according to the rules, then of course there will be a slight chance to get in the car accident, but it's not going to be high, right? Because you stick to the rules. The same thing exists for financial market. So some kind of safety measures, we could call them like this. So what is risk management? There is a saying, do not put all your eggs in one basket. It is not good, because if you drop your basket, all the eggs will be broken. Yeah, so if you keep your eggs in different baskets, even if one breaks, still you have the other 4 or 5, right? So you're not going to be hungry. So in the same way, when you trading in Forex market, if you're investing all your money only in one currency, you're basically putting all your eggs in one basket. Because if the situation in market changes, and basically you will be losing on all your deals, yeah, if you're investing just in one currency. If you're only buying euro, let's say. So if euro will be going down, you will be losing money on all your deals. Yeah, so we recommend traders to avoid this kind of situation, to stick to risk management, yeah, and that means not to put all the money in one deal or in one currency. So to open different deals on different currencies, on different commodities. So instead just trading on euro, for example, you opening deal on euro USD, on GBP Australian dollar, on Canadian dollar, couple of deals on gold, on silver, on oil, and so on. So even if 1 or 2 of these will not be profitable for you today, yeah, the rest might be profitable, and you might close this day with a profit. It's also important to remember that even the most experienced traders, they are not making only profits all the time. Okay, it's impossible to have 10 out of 10 deals in profit always, every time. Yeah, so it's completely normal if you have sometimes deals with loss, and it's important to explain the client before he starts investing. Yeah, that sometimes you might lose money, that's fine. As soon as your statistics is at least 7 profitable deals out of 10. So in that case, you will have more profits than losses, right? If you're opening the same equal deals. And in that case, it will be a good result. Yeah, so at least 7 out of 10 is already a great result. 8 out of 10 profitable, even better. So it's easier to achieve this result if you diversify your risks, if you stick to risk management and basically not putting your eggs in one basket. The other thing which I would like to talk about is called money management. So this is the way to manage your balance, your money. As you can imagine, when you receive a salary, you don't spend it in the first day all on, let's say, clothes, right? Or you don't go and buy something expensive at shop for the whole salary. Because you need to pay your bills, you need to pay for communal services, for the gas for your car, you need to buy clothes, to eat something, right? So you separate this amount for the whole month, so you have enough to survive, and maybe even save something for future trips or something else. So in the same way, you need to treat your balance, your deposit in the trading. So that is why it's a very bad idea to invest, let's say, all your balance or half of the money on your balance just in one deal. Yeah, because then the level of risk is higher. Yeah, if something goes wrong, you will be losing like pretty big amount. So that is why it's recommended usually not to invest too much money in one deal. Maybe a couple of percent of your balance, yeah, maybe 5, well, no more than 10% at least, yeah, of your total balance in one deal. So in that case, you would be able to open more deals, let's say a dozen of deals, and even if a couple of them will be with negative P&L, you will have loss on them, then the others, for example, are profitable, and altogether you have positive P&L.